So we just dive into capital gearing quickly, and we start looking at it as fast as possible. I hope we can finish this long-term solvency stroke leverage today, if possible, and move into investment so that we can at least leave these ratios. I guess you guys are beginning to get bored.
No, not really. It's good to know them.
Okay. It's actually number one most of the times of the examiner financial statement analysis. So it's good we know all the ratios. Yeah. Okay, so let me discuss the capital gearing quickly, which is one of the main one. In our last mock exam, we saw he tested gearing in requirement 2 only. No issue. He just decided to test gearing as part of the requirement 2. He's so pimped. So let's look at gearing in this cost ratio section. Okay, so capital gearing measures the extent to which an entity's long-term funds have been provided by lenders. So long-term funds in terms of borrowed debt, like debentures, loans, bonds, and preference shares. So the capital gearing ratio looks at more financial risk towards borrowed funds. So the formula is clear on the screen. It's stated as the preference share capital plus non-current liabilities. The non-current liabilities does not include anything that has to do with tax, maybe deferred tax that is long-term. Deferred tax is a government obligation, but any obligation to a company that is owed funds is what the capital gearing ratio looks at. So the preference share capital inclusive of the non-current liabilities, exclusive of any liability that is not debt, while our denominator is the total share capital, which is equity plus preference, reserves plus non-current liability. So we're looking at how geared, how external lenders own a portion of the capital structure of the company. So we're looking at the percentage of capital external borrowers in form of preference shares, non-current liabilities in relation to the total capital structure. And that's why you hear of the company highly geared. So if fixed interest capital, people that have fixed claims on the company, if their percentage is higher than the total capital structure, above 50%, then the company is highly geared. And if it is lower, it's slowly geared. So let's look at the percentage of like 1 to 20, 20 to 50, then 50 to 100, depending on the industry average. So we use that to measure the high, medium, low method of whether the company is highly geared or not. Yes, please, go ahead.
Non-current liabilities is in the numerator and denominator.
Exactly.
So are they the same? Why add them up when you just cancel them out? Why not just preference share capital over total share capital reserve?
Okay, so you can't take only preference share capital as the numerator because there are other fixed interest elements like bank loan, bonds. So they must form part of the numerator. Don't forget we are looking at fixed interest. So if you cancel out, if you cancel out non-current, you are diluting or removing some elements of the debt on the numerator. So it's good you add them together. I understand your cross multiplication and canceling, but it's better to have a better result by following it straight up this way.
Then the non-current liabilities.
Yes.
Is it also all them debts and loans and all that at the denominator?
Yes. So all the loans. Now, if you look at the numerator, there is no ordinary share capital because ordinary share capital is not a fixed interest debt. But in the numerator, you see total share capital where ordinary share capital is added to the denominator. So total share capital plus reserves plus non-current liabilities, and non-current liabilities is mainly fixed interest. So the main difference, so the main difference.
This total share capital is preference share included.
For the numerator,
the denominator total share capital.
Yes,
Preference
yes,
share
yes.
included.
Yes,
Ah,
preference share is included. Exactly.
okay.
Yes,
Okay.
yes, yes,
Sorry.
yes. Yeah. So good question, because this gearing normally futures most of the time, and it's always coming out. So it's good we
Awesome.
ask questions. Yeah.
So
So
the denominator
welcome.
is every form of every form of borrowing, every form of
Exactly.
borrowing, every form of borrowing, whether it's share
Exactly.
capital, preference share, loans, long-term loans, everything, everything.
Exactly. Exactly.
Okay.
Exactly. You got it right. You got it right.
You said
You're welcome,
apart
Aisha.
from deferred
Thank you, sir. Good
tax, that's
evening.
for the numerator.
Yeah, good evening. Mm.
You said apart from deferred tax.
Mm. Yes. Why we don't include deferred tax in computation of interest, capital gearing, is because we just want to look at external debt. Deferred tax is not a debt; it's an obligation you owe government. You didn't borrow
Sure.
it.
Okay.
Yes, so we don't include preference share capital. Exactly. Any debt that is not borrowed and fixed interest, you don't pay interest on deferred tax.
Yes.
So yeah, so preference
Okay.
shares, loans, and any form of borrowings that you pay interest is what you concentrate on capital gearing. So take note of that.
Okay, sir. Thank you.
Yeah. All right. You're welcome. Sorry, I was saying hi to Aisha. Aisha, I was fasting today.
Aisha, good evening.
Mhm.
Good evening. Fasting was fine. Thank you so much.
Oh, that's nice. How was work too?
Thank God. It wasn't stressful as a regular
Ah,
one.
better, 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 better. We've
Well
been
done.
engaging with a very fantastic conversation with Julie on gearing. This gearing and ungeared, it can be very, very tricky. The
Tricky.
examiner likes
Yes.
to.
In fact, I'm seeing
So,
this formula for the first time.
wow. Okay, so maybe I'll let Julie go over it again, because she was saying something. She was asking a very interesting question, and she struck somewhere that I think you need to hear. Julie, go ahead. You said something on the numerator about the fixed interest.
Okay. Like what I was asking, the preference share capital are all and preference share capital on top and the total share capital at the denominator. I'm sure you can see it clearly. The total share capital, I was asking if preference share is part of it. He said yes. Then I also asked that deferred tax if it's also part of the non-current liabilities. He now said, because we do not
No.
pay interest on deferred tax, it's not going to be included in both the non-current liabilities on top and below. So that's it
Okay.
basically. And it's all the external, what do you call it again? The
External debt.
denominator comprises
External debt.
External debt.
the denominator comprises of all the external debts, all of them. The only difference between the numerator and denominator is the equity shares and the reserve. So
Oh, yeah.
that's just it.
Exactly. Exactly. That's
And
it.
again, I
So,
think deferred tax, since it's a tax, is not a debt, right? It's like
exactly.
Yes,
Yes.
it's
it's
to the government.
exactly.
Okay.
So that was my main question on the total share capital, what it comprises of, if preference share is part of it.
Okay.
Yeah.
So, but it's now singled out as the numerator, and then the denominator captures everything.
Yeah, exactly. Everything.
Right. Thank you
So,
so much.
Yeah, I love this conversation. That's good. It shows we are grasping the idea. Yeah, so it's easy to just compute and cram the formula, but during exam condition, if you don't understand it, you can easily forget. So I like the conversation. Yeah. All right. So looking at another explanation here, the capital gearing ratios measures the capital that is financed through debt versus equity. So you see the difference between the numerator and the denominator is just equity, then reserves. So you want to see your numerator as your debt and your denominator as the total capital structure, including preference, equity, reserves, and any debt that's inclusive. So you want to know the percentage, the fixed interest element, and the financial risk what's the percentage of it to your capital structure. So if it's above 50%, then you have a problem. Your company is owned by external providers of capital. But if it is lower, internal providers of capital have a larger chunk. So that's what so you are highly geared when fixed interest borrowing has taken over your capital structure. Then you are lowly geared when the internal providers of capital, ordinary shareholders, have a higher percentage. And if it's balanced 50-50, then it's good. That is the best position or situation the company is supposed to be in. So just understand the dynamics, and it's easy to apply under exam condition. Okay, so it provides insight, like I said, financial risk. So we're looking at risk of your finances being held by external people, and it's associated with the company's capital structure, and its reliance is on borrowed funds. The money you borrowed, and they say, okay, you pay the principal and you pay the interest. So the reliance is on borrowed funds. Take note of that. Now, a higher capital gearing ratio indicates that the company has greater proportion of debt in its capital structure. Exactly. And it can impact its financial stability and risk profile. Yeah. So if you have, like the last exam we saw, you saw the gearing ratio, the calculation was about 96% in that question. That means external providers of capital owned 96% of the company, while shareholders only owned 4%, which is extremely high in that last May 2016 question. So take note of that in the interpretation. Okay, so this is another way of tweaking the formula. Instead of calling it preference, so you just call it long-term debt divided by equity plus long-term debt. This one is a bit easier to understand, and we have the interpretation here. So this is the numerator. The numerator looks at preference share capital, loans, bonds due beyond 1 year. Due beyond 1 year. So any debt that is due beyond 1 year, most deferred tax are paid after a year. Your taxes are paid in a year. So if you defer it, next year is due. But some preference share capital covenants could be 5 years, debentures could be 5 years, bank loans could be 5 years, bonds could be 10 years. So any debt above 1 year is qualified to be a long-term debt under the capital gearing computation. Then the equity refers to as your equity, your ordinary stock or ordinary shares and preference shares included when you're calculating the denominator. So before we go to what it means, let's use Dan Kabir to compute the ratios very, very quickly. Let me share the document so that we can practicalize this, and I believe it will sync. Trying to share my screen. Okay, so let's go to Dan Kabir and pick our items. So take note of the numerator, and everything is on our SCI. Sorry, our SFP, I beg your pardon, our SFP. So from the formula we have, let's go back. We have long-term debt, which includes preference, loan, bonds beyond 1 year. So we go down and pick those items. So don't forget we are taking the ending. So let's take our preference. This is a debt. So don't forget, share capital is not a debt. It's owned by ordinary shares. Share premium reserves. Share premium is almost the same as reserves. It's not a debt. Retained earnings is not a debt. It's the plowed back profit we kept into the company. So the only numerator we'll pick here is 105, and that will be preference share capital. I will pick bank loan. I will pick bonds payable. So you can see deferred tax. We can't pick deferred tax for capital gearing ratio because deferred tax is not a fixed interest element. Take note of that. Okay, so let me pick these three at a go, if possible, so that we can be faster. I shared the document, so I believe we can follow through very easily. Okay, so we have our total, based on our formula, we have our long-term debt. We have it as 577,500,000. So this is our total long-term fixed debt. Sorry, Julie is saying something.
I'm just looking at it. That's bonds and
exactly. So the fixed interest debt are preference shares, bank loans, and bonds. So these ones have fixed interest, and that's our numerator. So let's get our denominator now from the screen, from the SCI. So our numerator will now be all the capital, all of them that are equity, and we'll pick bank loan and bond as
plus
excluding VAT tax. Yes, plus retained earnings, exactly. So this total
share premium, retained earnings, everything.
Exactly. Everything that becomes to ordinary shareholders. So
Okay.
what I'll do is, yes. So what I'll do is I'll just pick these three, since I've already picked the other three. So I'll just pick these three so that I can total it. Okay, so I have retained earnings. Good. So let's go and take these three now and add them to our capital structure. So just imagine this is your capital structure, internal and external debt. So look at it this way. Okay, so I now have the total of the capital. So total capital, exactly, which includes equity and debt. That's the total capital, which is 1,052,500,000. So what is our capital gearing ratio now? Will now be the percentage of the long term with the total. So let's do that. So this divided by, I struck the wrong cell. So let me come down here. So this divided by this. Okay, good. So I have 38%. So external providers of capital constitute 38%. So is it low or high in your opinion, or is moderate?
It's low. It's good. It's a good one.
It's okay.
It's low.
Yeah.
Yeah, I agree. I agree too. So it's a good one.
The internal, the company is in control of its debt.
Exactly. Okay, so let me ask a question now. Aside this 38%, what is the ordinary share percentage? If 38% is for external, so internal is what percentage?
It's going to be 100 minus 38.
Yeah.
Exactly. And what is that?
62.
Good.
100 minus 38. 60.
Exactly. That's correct, Aisha. So ordinary shareholders constitute 62%, which is good and safe. So as far as 50-50, the company here, if I listen to your interpretation, means this company is lowly geared. Do you guys agree?
Lowly geared, yeah.
Lowly geared.
Yes, exactly. Lowly geared, yes.
It's lowly geared. Good. So anything above 50, 60, 70, like we saw in the last mock exam, you saw 90%. That one is highly geared. So anything above 70, 80%, man, is highly geared. So 50 downwards, I agree, is slowly geared. So it's good we understand this from this perspective. I like it. Okay, so can we do 2022, 2023 quickly? Can you just run through the figures for me? Let me see if they are also lowly geared. So as you are doing it, I'll just be picking the figures so that you guys can.
Because my system is still coming up. I'm using
okay. Okay, I believe Julie is having her calculator already. So
the thing is, it's not easy. It's complicated. It is complicated. I'm trying my best.
I understand. You'll grasp it. After this class, you look at it again, and I believe you'll grasp it. It's easy, but it's not simple.
Okay, we didn't look at short-term borrowing because it's below 1 year. It's less than 1 year.
Yeah.
Exactly. So we're coming to ratios that look at that.
So equity is the difference between the top and the bottom.
Exactly. Equity reserves and
Can I look at your calculation? On the calculation you did, can I see it, please?
Okay. All right, here am I.
I want to see. Okay, your equity. Okay, they already gave the total equity for 2000 and did you if you pick it, Tunko 1050.
Yes, it's fine.
Okay.
It's fine. If you pick the total equity, it's fine.
Okay.
My system decided to misbehave today. Okay.
Right, so I've gotten the top. So let me bring that same top down here so that I just duplicate it. Okay. So I just go and pick share capital.
For 2021, I got 35.95. That's 36%.
Okay, fantastic. 36%.
Yes.
Okay. Is it 2022, right? That's what you're doing.
2021.
No, we just did 2021. We had 38%. So you're doing 2022.
Sorry. Oh.
Don't forget, it's the ending. Yeah, we are doing the ending. So we have.
Yours was 2020. Yours was 2020.
Yes, it was 2020 I did. Oh, sorry. So from here I went on. So this is the year change that I made a mistake. So let me change it back. Okay. We are on the same page now. Okay. So for 2021, 36%, exactly. Good.
Sorry, my system is still coming up.
No problem, Aisha, no problem. Okay, so Julie, what do we have 2022?
2022, we have just 1 second. I'm almost done.
Okay.
We have 36.6.
So let me say 37%. Okay, that's fine. So 37%. Let's see if we align together. I've already gotten the figures. So let me get the total here. And let me just drag with this too. There's somewhere we are perfect with 2021, but we are not with 2022. So who is wrong?
Let's see. 105.
Somebody is wrong.
What's your total? What's your total share capital? 39854719.
Hope I picked the right figures.
Share is 105. Oh. You pick 3. Look at your calculation, please. Preference share 222 is 105,000. It means, yes, up there. Preference share capital is 105, not 39.
Yes, exactly,
Yes.
exactly. Yeah, that was it. How come I've dropped
So
to
it's like
25%?
Okay, let's see again. 105. Bank loan is 398,475. Let's
Okay,
look at
bank
it.
loan.
Look
Bank
at
loan.
it again.
Yes,
Bank loan
398,475.
475.
Yes. So bank loan is 398,475. Then what of bonds?
199.
Exactly. So I think my bank loan is wrong. Okay. Okay. I
The
think
bond
we
is
are aligned
correct.
now. Yes, we are aligned
Yes,
now.
okay,
So
now, right?
yes, we are okay. Thank you for that. That's why it's good to do it independently and not just follow. So you have the same figure. All right. So Aisha, are you okay?
Yes, I'm following.
Okay, fantastic. All right. So there's another one, but it's not popular. So we'll do that one, and that is why it's not part of the ratio computation. So before we get to the explanation of the meaning of this capital gearing ratio, that one is tested seldomly and is called debt to capital.
Excuse me, sir. This long-term solvency is the same thing as gearing, right?
Yes, but no. Long-term solvency looks at leverage. So when you say gearing just looks at one ratio, and the gearing is on fixed interest capital. So a synonym for long-term solvency is leverage ratio. You are leveraging your financial capital structure. Yeah. So gearing is just a part of long-term solvency. Okay, so this column, we're going to calculate debt to capital. So what do we mean by debt to capital? So just follow me closely. It's not popular. So that if you see it, I don't want you to be taken aback. Don't be taken unawares by the examiner. So when you see debt to capital, it sounds like gearing, but it's not gearing. So what are the components? The components of gearing or debt to capital is your long-term and short-term debt compared to your total capital. That is what just it means. It's very simple. So take it very, very simply. So there's no issue of fixed interest, internal or external. So when you hear debt, just know it's your non-current and your current liabilities. So we are looking at the total debt compared to the capital structure. So I'm picking for non-current liabilities now. You can see everything, including deferred tax liability. So it's a debt you owe, and is another variant of capital gearing ratio. Just take note of it, and I'll take your questions after that. In case you see it, it's hardly featured. The gearing is featured more because it's a more practical way. This one is not too practical. It's more of academic, but I'd like you to know it so that if you see it, you don't panic in the exam or debt to capital. Which one is debt to capital? It's just simple. It's your total non-current liabilities plus your current liability. Very simple. So I'm picking the total current liability. This is it.
So it's the total current liability.
Yes.
Total non-current.
Total liability itself.
Yes, total liability. That's the right word, Julie. Total liabilities. And that is what is called debt. That is why it's called the debt. So this is
the expenses, short-term borrowings, trade payables, everything.
Exactly.
Every debt.
Yes, every debt. So this is our
total liability.
Yes.
So total liability divided by current liability divided by non-current liability. Is that it?
No.
It's total liability divided by total liability plus equity.
Thank you. Yes, exactly.
Okay.
So this is your total liabilities now. We are having this plus this. So this is total liability. If we go to the SCI for 2021, we should be able to see
45.
yes, 945. You can see it here. So that's our total liability, not current. So what will now be the capital? Because we are dividing it by capital.
That'll
So
be
our total capital will now be this
share
plus,
capital.
you get the point
Plus
now.
equity.
Yes, plus equity. You get the point now. So let's go to equity and we'll just pick the numbers. We won't waste time. So our total equity is
050.
1050 exactly. So let's just pick the equity and add it. So that forms our total capital. So this will be our total capital. And let's add this other debt. So debt is 945123. And 45123. Okay. So let's say our total capital this is total equity. I beg your pardon, not total capital. Equity. Good. So it's fine now. So now we'll do debt to capital ratio. And that will be 945 divided by 195. Exactly. So we have it as 47%. You can see it's different from gearing. Gearing is 38. So this is 47. So your total debt, internal, current and non-current, is 47% of your capital. So since it's a debt to, we'll just do it like this: 0.47 is to 1.00. So when you hear debt to or debt to equity, debt to, it's a ratio and not a percentage. But when you hear capital gearing ratio, you know it's a percentage. So when you hear debt to, cash flow to, when you hear anything to, you are comparing one to another. So our total capital is 1 and our total liabilities is 0.47. That's what it means. Very unpopular ratio, is more of an academic, but it's good to know in case it pops up. Once you see it, the examiner wants to. Yeah, please go ahead. Yeah, please.
So denominator is a combination of equity and debt and total liabilities.
Yes,
Yeah?
yes. The denominator.
Okay.
Exactly.
Okay, for 2021, 48.27, 2023, 49.5.
Okay, so give me the figures again so that I'll just validate it.
2021, 48.27, then 2022.
So can I call it 0.49 is to 1? Is this correct?
No, 48 is to 1.
Okay. It's not
just say 48. 48,
okay.
Yes.
Okay.
Then the other one is even if 49.5, that's 50 to 1.
50
0.5.
Okay,
Yeah.
thank you. So we won't waste time. We'll just validate it by going to our SCI. Then we'll just say, where's our total liabilities? I've given you the variance. So I just pick these two, total liabilities, and I'll come here and add it to this place. So these are our total liabilities, exactly. Then our debt, our total capital, we'll just go and pick it here. So we just have these two here as our total capital. So we'll add them when we go back. So this total capital, this is it. Exactly. So debt to be added to. I'm getting something wrong. Okay, yes, this is our debt. This is our capital. Exactly. So let me just drag and see if we align. No. So, Julie, which one is our debt? Which one is our capital?
Our debt is why not that? I thought you add it. Are we adding the two together?
Yes.
Now for the denominator. Yes.
Yes.
Abi?
Yes.
That's what I did.
Yes. So the debt is 1033825
1194.
Okay, yes, we're adding these two. That's true.
Adding the two for denominator, yes.
Yes. Oh, okay. All right.
Are we not supposed to do that?
Yes, we're supposed to do that. All right. We did it with the first one.
Yeah.
Exactly. So I'm dragging and I'm wondering why my formula is giving me something different.
You didn't add the two.
Oh, okay. I didn't add these two. That's the total equity. Okay.
The equity was at the top.
Okay. Yeah. So did I pick
113 1,113 should be up above 1,038,000.
Okay, thank you for that. I think I got it mixed up there. Okay, like this, right?
Yes.
Okay, so I'll now total
that's
right. Yes. Thank you for that, Aisha. I got it mixed up. Exactly.
Yeah.
Thank you. Thank you so much for that correction. All right, Julie. So we are on the same page. Thank you so much. So you can see the result. Yeah, so the result is different from this. Now, what's the interpretation? Because it's not on the slide, because this is not too popular. So the interpretation means that your total obligations, don't call it debt, because these are obligations. Yes. So your total liabilities are obligations you need to pay. Okay, sorry, Aisha, you're saying something?
No, I'm saying because of the element of deferred tax and
exactly. And yes, they are not fixed interest. So they are just debt. They are just your debt. So take note of those two there. This one is unpopular, but I need to bring your attention to it so that you get, I need to get you prepared in case. This is much more tested. This is tested very, very popularly. Capital gearing is tested and is popular, but this debt to capital is not tested. It's more of academic and to some extent is not practical. But then, yeah, it's not practicable. It's not really in practice, but it's good you know it, that the debt is your total liabilities, then the denominator is your total equity and debt. Exactly. Okay.
So you're trying to tell us the meaning, the interpretation rather.
Okay. So what does it mean? It means that the ratio to your total capital structure, what you owe is less than what you own as a capital structure. So your capital structure compared to what you own is also low. 47% is your obligation you are supposed to pay. But now your total liabilities, 47% is total structure of that. So it shows that you are, let's use the word geared, you are still lowly geared, if you want to use the word geared, compared to what you're supposed to obligedly pay to people outside. If it's more than 50% now, that your total liability is more than 50% of the total capital you have, then you have an issue. You may be highly geared, if we use the word geared. So in this case, I think 50% is okay. He balanced his total liabilities, especially in 2023, with that of equity and the total capital. So he's still lowly okay, in my opinion, lowly geared, and his liabilities are not going out of hand, and that is what it means. I hope that's a bit clear.
Yes, sir.
Okay, fantastic. Aisha, you're okay with the in the interpretation, right?
Not too okay. Well, I'm just like okay.
No. So go ahead and let me know your challenge, please. I know Julie got it, so go ahead, take your time.
The 50% now shows that their ownership and obligations are at par.
Exactly.
And then the 47% shows that they have 47% ownership or 47% obligation? I'm trying to get that.
Yes, 47% obligation for 2021, 48% obligation for 2022, and 50% obligation for 2023.
So 47% shows that the obligation is high.
No, it's low. It's low.
It's
lower.
low.
It's not even up to 50%. Yes, it's low.
So it's reasonably okay.
Yes, it's
exactly.
reasonably okay.
I think it's reasonably okay. Yeah.
Mm-hmm. So if you use the lowly
I'm good
geared
now.
language, yes, if you use the lowly geared language, it means they are lowly geared. If you want to use that language, yeah. So anything from 50% shows that, man, the obligations are becoming higher than the capital the company owns. Exactly.
So they need to check. Okay.
So I think it's higher because I think for that 47 it's already in the one. Sure, you guess. Yes. That 47 is already 0.4 is already in the one. So I think it's even closer.
And you know why it's not close? Because total equity was not in the numerator. So total equity is part of the money injected in the company. So you will not say it's in the one. So total equity is the total liabilities. Use liability as the listing, even though equity is seen as the company's owned investment.
We added it to. We barely have how do I put it? 0.47 is in that one. It's part of the one. So what do we have left? 1 minus 0.47.
51%.
50, yeah.
53
belongs to 51. Okay, 53. Sorry.
53.
Yes, 53 belongs to total equity.
Equity. Yes.
Yes. Yes.
So it's kind of close, It's kind of close because.
So they should check in their long-term and short-term borrowings, yeah.
Their long-term it's because the equity. Let's say they are going to be solvent now. What will be left of the equity will just be how much? 53%.
Yes,
not 53%. That's going to be left for the shareholders.
For shareholders, yeah. So 53% is still good, but anything lower in the interpretation is catastrophic. So 53%, I think, is still, yeah. 53% of the ownership of the company is still controlling interest. So if you look at it from control, 53%, yes, is still a controlling interest.
So anything from 50% is deadly.
Yes, it's deadly.
No.
Exactly. But for banks is allowed. Do you know why? Because banks, most of their shareholders are external. So for banks is allowed. That's why you see
definitely liabilities, yeah.
You get it. So for banks is allowed for expansion.
I don't understand.
Yeah, so for banks, if you have 90%, 99%, most of their shareholders are external. So that industry is highly geared.
Highly geared.
So that industry is highly geared because the capital is intensive.
So their own advice can be this.
It can be this, yes, because this one is an FMCG. This is a fast-moving consumer goods. But banks, investment companies, you even see some of they may not even have shareholders. Most of their debt come from outside. External, exactly. So for banks, the conversation is a bit different. So take note of it. I really love this conversation. It's yielding a lot of results in terms of understanding. Okay, so we go back to our conversation on what the gearing ratio means, because this is popular. I didn't do anything on debt to capital because it's not popular. But this gearing is very important because the examiner tests it very frequently. So what does the gearing means when it's higher? So looking at the question we did for Dan Kabir, anything above 50% is higher. So Dan Kabir is lowly geared, but anything above 50% is highly geared. And it means that the higher degree of financial leverage, meaning the company relies more on borrowed funds, which can enhance returns during good financial times, but increases risk during downturns. Exactly. So the company can rely on borrowed funds. It will enhance them during good financial times to get returns. But once there are downturns and there are no returns from those borrowed funds, it will sink the company because there's fixed interest. So whether you do well, you don't do well, you must pay those interest. Like the preference shares are called restrictive covenant. It's a covenant you must pay whether you make interest, whether you make profit or not. So borrowed funds are good when there is boom. The economy booms, you make a lot of profit, borrowed funds recover. But once there is a dip, the company is in trouble. So that's the risk in the gearing ratio. And the implication is that a higher gearing ratio suggests the company may be more vulnerable to economic downturns. So you've got to collect money from external providers of capital, and you are obliged to service that debt in form of interest, and you also pay the principal. So if economic downturns affect the company, that would be to its disadvantage, and that's the implication of a high gearing ratio. While a low one indicates a more conservative capital structure, like we saw in the case of Kabir, with less risk associated with debt financing. So your company is intact, you still have your controlling interest, and you have your say or the AGM, and the company is still within your grasp or your grip. But anything above that, you are sliding into losing control. And that's the advantage of a lowly or a lower ratio. So a lower ratio can also be attractive to investors seeking stability, people that want to be ordinary shareholders, and it may also imply lower potential for returns during period of strong performance. So some people forecast and say, okay, the economy is going to boom at this time. So financial advisors, financial forecasters, experts will just say, okay, let's go for a high borrowing so that we can take advantage of this booming economy, make money, and pay off the interest and the capital and retain our shareholding. So strategic finance analysts do that in terms of boom. And when they notice the economy is dipping, they avoid borrowing. Why? Because if you don't borrow to some extent, you may not be able to expand and get high returns. Because borrowing, they say the higher the risk, the higher the rewards or the return. So when you risk it, you borrow and you invest it wholly, you could get a lot of returns during a period of strong performance. So now this is where chartered accountants come in, and experts, investors, they come in to look at the economy. And during times of boom, they dive in, borrow money, expand, and pay off those debts to retain their control. So what are the causes and effects? Causes of a high capital gearing ratio is aggressive borrowing for expansion. Exactly. If you look at these banks, what they do is they borrow money to expand, build more branches all over. And that's part of the reasons. Aggressive borrowing is the reason for high gearing. Lower equity financing. Mostly banks, they have very low equity financing and high interest bearing elements, high debentures, high bonds. Why? Because they need to expand. And the effects is increased financial risk. So when you do that, you borrow aggressively, susceptible to financial risk, greater obligations to pay interest. The higher the principal, the higher the interest, and potential challenges in economic downturn. So these are the effects when things don't go the way it's supposed to. While the causes of a lower gearing is conservative financing strategy, especially for some industry like FMCG, pharmaceuticals, and some medium-sized company would prefer this lower gearing ratio to retain control, while higher reliance on equity or lower levels of debt is the cause of a lowly geared company. While the effects is reduced financial risk, greater flexibility in times of financial distress. Yes, so they are not moved during financial distress. They retain control and navigate those times very seamlessly. But potentially they have lower returns on equity due to less leverage. So what is advised is balance. Take advantage of your leverage, external borrowing, take advantage of it when needs be, and always run back to safety. Always run back to safety. So in conclusion, this capital gearing ratio is a critical indicator of a company's financial structure. It reveals the balance between debt and equity. So at most, for most industry, let me say excluding banks, 50-50. 50-50 is okay. If you even do 60-40 in favor of debt, run back to retain control, because 40% equity is not more control. You've slided into
Associate.
Exactly. So even if you slide into associate, get the money, get the returns, pay off your debt, and go back, buy up your company, take over your control. It's important. So balance between debt and equity in financing operations is key. Understanding this ratio helps stakeholders assess the financial risk and leverage of the company. So this is the same word that keeps resonating and ringing: balance. Balance. In all the ratios, balance is essential for long-term sustainability, as it enables the company to navigate economic fluctuations while maximizing growth potentials. So this is very important. So take note of this. You can go back to read after this class so that you can understand the examiner's tricks. You always test this gearing very, very frequently. And also don't forget to also practice the debt to capital. That includes long-term and short-term, current and non-current, though unpopular, but just practice it to have a feel in case anything shows up in that direction. All right, so this is 9:57. Let's go on 10 minutes or 15 minutes